Most people think tariffs are about trade, about factories, about jobs, but that's not where the real story is hiding. The real story lives somewhere quieter, in bond auctions, in yield curves, in a market most people never look at until it breaks. When tariffs rise, prices rise. When prices rise, inflation follows. And when inflation follows, the cost of borrowing for an entire nation quietly shifts. Homes, cars, business loans, government debt. This is the hidden cost of protectionism. Not paid at the border, paid over decades. Tariffs can look like revenue, like strength, like leverage. But underneath, they reshape the market that funds the US government itself, the Treasury market that anchors the global financial system. If you want to understand where this story is really heading, stay with me. Because once trade policy starts moving bond yields, the consequences reach far beyond politics. And if this kind of analysis helps you see the system more clearly, consider staying with the channel. Now let's slow down and define the problem properly. Underneath the headlines, this problem is not about whether tariffs are good or bad. It's about how a trade decision ripples through a financial system built on trust, scale, and expectations. The United States runs large budget deficits. That means it must constantly borrow, and borrowing happens through US Treasury bonds, the safest, most important financial instrument in the world. Here's the tension. Tariffs bring in revenue. That revenue can slightly reduce how much the government needs to borrow. On the surface, that looks stabilizing. But tariffs also raise prices. They push inflation higher, they distort growth, and they inject uncertainty into future policy legal challenges, political reversals, and shifting strategies across administrations. Bond markets don't like uncertainty. They price it in, so the same policy that appears to support government finances can, through inflation and volatility, push borrowing costs higher instead. This is why trade policy and treasury markets are inseparable. One shapes the other. To understand why this balance is so fragile, we need to step back and look at how the US ended up here in the first place. For decades, the US government lived in a different fiscal world. From 1980 until the pandemic, deficits existed, but they were manageable. Borrowing grew alongside growth. Debt markets absorbed new bonds without stress. That balance changed after COVID. Spending surged, revenues lagged, and the deficit settled near 6% of GDP, roughly double the long-term historical average. In simple terms, the US now needs to issue far more debt, far more often. That makes bond supply the central variable. Every additional dollar of deficit must be financed. Every new bond must find a buyer. And if buyers hesitate, yields rise. This is where tariffs enter the picture. Tariffs don't just shape trade flows. They generate cash, and cash, even at the margin, can reduce how many bonds the government needs to sell. That's why tariffs started to look attractive, not just politically, but fiscally. But this is a delicate trade-off, because the same policy that trims bond supply can also undermine bond demand. And that contradiction is where the first real stress begins to appear. The stress became visible when tariffs stopped being theoretical and started showing up in the numbers. Tariff rates surged to levels not seen since the 1932. Revenue followed. In a single fiscal year, customs duties jumped dramatically, contributing to nearly $195 billion collected by the federal government. On paper, this looked like relief. Less borrowing, less pressure on bond markets, but the relief was fragile. Legal challenges loomed. Courts could strike down the authority behind those tariffs. If that happened, analysts estimated that tariff revenue could be cut roughly in half, almost overnight. At the same time, new spending commitments pushed the deficit higher again, threatening to erase any fiscal gains tariffs had delivered. Markets noticed. Investors began recalculating not just how much debt would be issued, but how predictable that issuance really was. Uncertainty replaced clarity. This wasn't a crisis yet. It was something more dangerous. A warning, and when warning signs appear in bond markets, they tend to surface first in places most people never watch. That's where we go next. What was unfolding wasn't about one budget line or one court ruling. It was about mechanics. Bond markets run on expectations. Not just how much debt is issued, but when, at what maturity, and under what economic conditions. When deficits grow, supply grows. When supply grows faster than demand, yields rise. Tariffs complicate this balance. On one side, tariff revenue can slightly reduce how many bonds the Treasury needs to issue. On the other, tariffs raise inflation, and inflation forces investors to demand higher returns, especially on longer-term bonds. That's the hidden mechanism. Even if tariffs reduce supply at the margin, they can increase yields through inflation and uncertainty. The bond market doesn't care where inflation comes from. It prices the risk all the same. Treasury officials understand this. They remember what happens when markets are surprised. In 2023, when debt issuance came in higher than expected, yields jumped. Credit ratings were downgraded. Stocks fell. Borrowing costs surged. That episode became a reference point, a reminder that bond markets punish miscalculation quickly. So policymakers tried to manage the risk. They adjusted issuance strategies, shifted maturities, bought time. But these are tactical moves. They don't resolve the underlying tension between tariffs, inflation, deficits, and trust. And as that tension builds, pressure doesn't disappear. It simply moves. The second wave of stress arrived quietly, a shift in demand. While tariffs seemed to trim supply, they couldn't resolve the deeper question, who will buy all these bonds? Traditionally, the answer was clear. Foreign buyers, US banks, the Federal Reserve. But the world is changing. Foreign demand for US Treasuries long. The foundation of global finance has been shrinking. Banks are holding fewer bonds. The Federal Reserve's influence has waned. And foreign investors, once loyal to US debt, are now more cautious. Since the pandemic, these key players have decreased their share of the Treasury market. By 2025, foreign investors are buying fewer bonds. At the same time, they're diversifying out of the dollar, driven by trade shifts and rising protectionism. That's why tariffs, while generating short-term revenue, threaten the long-term stability of bond demand. Without steady buyers, even small changes in supply can send yields skyrocketing. It's not just a US problem. The entire global financial system depends on the stability of Treasury bonds. The market for US debt may still be the largest in the world, but it's no longer the only game in town. This is the quiet danger. As tariffs close off trade, they push the world's money elsewhere. Now, it's time to look at the real-world consequences, the ones felt by everyday people. When tariffs increase, consumers pay more, inflation rises, the cost of goods goes up, whether it's clothing, electronics, or food. But it's not just about prices. It's about the ripple effect, the quiet, long-term toll of borrowing costs. Higher bond yields mean more expensive mortgages, higher car loan rates, more costly business loans. It's a chain reaction that eventually hits working families and middle-class Americans. Think about it. Your paycheck might stay the same, but the cost of your home, your car, your student loan, and even the groceries you buy each week goes up. This is where trade policy stops feeling like something happening in Washington and starts to hit home. It's where policy meets reality. And it's not just about the here and now. It's about the future, too. What happens when borrowing costs rise across the board? What happens when consumers can't afford to buy homes or businesses can't afford to invest? The answer is clear. The economy slows down, job creation falters, and households face even more pressure. This is where the tension between short-term trade revenue and long-term economic health begins to make sense. The consequences of U.S. trade policy extend far beyond national borders. What happens in America ripples out across the world. The U.S. Treasury market is the backbone of global finance, so any volatility here doesn't stay contained. It affects foreign economies, currency values, and investment strategies. Take the impact on global trust in the dollar. As the world's reserve currency, the US dollar benefits from the stability of US government debt. When that stability is in question, when Treasury yields spike or the market falters, foreign governments and investors notice. Countries with large reserves of US Treasuries begin to rethink their strategies. Some might reduce their holdings. Others could shift to alternatives, like gold or other currencies. And it's not just central banks. Private investors, too, watch the US bond market closely. If they start to lose confidence in the stability of treasuries, they'll look for safer havens. Maybe Europe, maybe Asia, anywhere but the US. This shift in global demand for US debt has real-world consequences. It means higher borrowing costs for the US government, which means more pressure on taxpayers. And when foreign investors pull back, the dollar's value can drop. That pushes up prices on imports and accelerates inflation. Suddenly, the US economy is caught in a feedback loop. Protectionist trade policies backfire, not just at home, but across the world. The future is uncertain, but we can still imagine three potential paths for what comes next. Scenario 1, the optimistic path. Trade policy evolves in a way that boosts domestic production without distorting markets. Tariffs gradually decrease, and the US shifts to a more sustainable fiscal approach. Demand for treasuries remains strong, and bond yields stabilize at manageable levels. The government reduces its deficits, and inflation is kept under control, allowing for economic growth without pushing borrowing costs too high. This is a future where balance is restored and both US consumers and global markets thrive. Scenario 2, the moderate path. Tariffs remain in place, but other policy shifts, like changes to corporate taxes or fiscal discipline, help stabilize the treasury market. Bond yields fluctuate, but foreign demand for treasuries continues, albeit at reduced levels. Inflation remains elevated, but not out of control. In this scenario, the US faces slow but steady growth with some painful adjustments as the government deals with fiscal imbalances. The global economic order remains relatively stable, though more risk-averse investors emerge. Scenario 3, the pessimistic path. A severe escalation of protectionism leads to higher tariffs and greater market uncertainty. The US Treasury market faces volatility, with bond yields rising sharply as the government increases debt issuance to cover the growing deficit. The US dollar weakens and inflation spirals higher. Foreign demand for US treasuries falls sharply, and the US government faces increased difficulty financing its debt. The global economic order begins to fragment, and a prolonged period of slow growth and instability sets in. This path could lead to a broader financial crisis with far-reaching consequences for global markets. These scenarios aren't just abstract ideas. They represent the very real outcomes tied to US policy choices today. The decisions made now will determine which future we face. As we look ahead, the choices are clear, but so are the risks. The Trump administration's trade policies have created fiscal leeway, but they've also introduced significant uncertainty into the financial system. The long-term cost of tariffs is more than just inflation. It's a restructured bond market, higher borrowing costs, and a global flight from US debt. To ensure the US economy remains strong and stable, policymakers must balance competing interests. First, reconsider tariffs. While revenue is important, it shouldn't come at the expense of economic stability. Targeted reductions in tariffs could ease inflationary pressures, helping to stabilize Treasury markets while still preserving some domestic manufacturing. Second, ensure demand for U.S. debt. Focus on building trust in the U.S. Treasury market by fostering global confidence and controlling fiscal excesses. Without this, we risk leaving the world's most reliable financial system vulnerable to shocks. Finally, act now to address fiscal sustainability. A comprehensive, bipartisan approach to deficit reduction is necessary. Failing to act will only accelerate risks of higher yields, hurting the U.S. economy and global markets in the long run. The stakes are high, and while the future isn't guaranteed, there's one thing that is. The U.S. must adapt its trade and fiscal policies or pay the price for its choices. If you found this analysis insightful, be sure to stay tuned for more in-depth explorations of economic policy and its global impacts. And make sure to subscribe to stay ahead of the curve.